Welcome to TheoTRADE. This is Don Kaufman. May 8th, 2024. 40 minutes left inside of the trading session here on this Wednesday afternoon. The S&P futures massively unchanged. I got to tell you though, look, expected move is just keeping markets packed in an incredibly tight range. But don't kid yourself, volatility still absolutely lurks in this marketplace. All right, let's get into some detail here, of course, on this TheoTRADE evening video. As I was saying moments ago, S&Ps right now, look, they're down like 1 point. As you kind of cruise down the list to some of the usual suspects, what do you got? Look, you can't really read into this. Financials are up 0.4%, right? Energy sector is massively unchanged. Tech is all over the place, predominantly some news driven, Tesla's down, but nominally came back over here. You start looking at the advanced decline line out there. It is slop-tastic. And that's why I'm telling you, don't read into any of that. What you want to focus on first is the SPX. And I'm going to show you exactly why. The SPX, what we're doing right now is we're just riding the upper edge of the expected move. Now, yes, this is the expected move that I talk about on every weekend update. And this expected move, we were riding it yesterday being, of course, Tuesday. We're riding it here, okay, into Wednesday. And there's no read on the market other than expected move. Now, let me actually zoom out to the daily chart for just a second. That was the intraday chart. On the daily, what has really occurred, this week? On Monday, we rallied. On Tuesday, we ebbed and flowed right into the expected move. Here we are Wednesday. It's all about the upper edge of the expected move. Now, here's what's important, okay? Because expected move is keeping markets packed in this incredibly tight range. When I say that volatility lurks, let me be very, very specific. The expected move that I'm referencing here, okay, right here, this line on the screen, that is roughly the 5190, okay? That level is 5190. Now, you got to translate because it's SPX. We're not talking about the S&P futures. Right now, we're talking specific SPX. S&P futures obviously trade at slightly different levels. Now, with the 5190, okay, we have a range, if you will, points of freedom that we can move, okay, around the 5190. Generally speaking, depending upon volatility, but generally speaking, you get about plus 12, okay, or minus 12 points. And if you're thinking about this, you're like, well, I'm not exactly sure what you're trying to show by 12 points. I'm trying to give you, okay, definitive ranges to watch for, right? Not just in like days to come, like now, here, all right? And what we're looking at right now with this 5190, add 12 points somewhere right up here, okay, at this 5202, we start to get above that and markets could break out to the upside. On the flip side, okay, it's 51, roughly 78. Now, the reason I'm giving you these ranges, and again, very, very definitive ranges, that is almost where all the trade has transpired in the last, 2+ trading sessions in here. Small breach to the downside. We rallied up over here. But when you start looking at these are completely tradable levels. And I'll give you an example, right? We start to actually come down a little bit. As soon as we cross below the 5178, it's a short. Why? Because at that point, okay, servers are going to kick in. They're actually going to push the markets off, okay, this 5190. The 5190, I call it the expected move. You got to think of this as the happy place for markets. That's because that's where risk goes to die. And as you're kind of, I call it like ebbing and flowing on it, you're just basically, skirting this 5190. You get, as I said, about 12 points, okay, of freedom on either side of that. So if we start to head to the upside and we start to cross through like, 5202, boom, we're going to break out. Why? Because market making firms are going to have to turn on and they're going to have to hedge in the dynamic of that marketplace. And that's an aspect that I've explained just dozens and dozens of times, this week. As I was saying, almost all the trade that has occurred has been inside of that range. And you can look specifically right, okay, in the neighborhood of that 51.78. The only trade that really occurred was in the morning, and then we just shot right back up into it. But the greatest part of this, if you had known that, this 51.78, okay, as soon as we cracked above the 51.78, boom, we're going to go. We're going to go right to the 51.90. And that is a tradable, tangible intraday setup. But as I said to you a moment ago, there's just no question that volatility still lurks. Obviously, volatility is going to lurk as we come off the edge of this expected move. And I'm going to tell you right now, we are going to come off the edge of the expected move. You still have Thursday and Friday. And moreover, if you have Thursday and Friday, this is where you actually go consult the SPX, right? You open up the May 10th expiration, which is Friday. Still recognize, even though you're like, volatility is so dead, man. Look, you still have almost $35 of movement packed in. Even today, okay, and we started the day on a little bit of a sour note. The S&Ps were down 20. They rallied back to massively unchanged over here. There's still some trade activity. Now, in addition to the SPX and the ranges I just gave you, okay, there's another aspect that kind of comes into play, and that is, okay, the bonds, which have been wildly bid, okay, the last week into this week, maybe a little bit of sell side activity there. This, okay, in the bond market, any further sell side activity could actually scare S&Ps to some degree. It has not as of yet. It's just, look at this. The bonds are down, what, a half a point. At this point, it's just, stalling out, okay? Any further sell side activity of the bonds could throw a bit more of a scare into markets. Moreover, if you take a look, the dollar, which got demolished following the Fed, following, jobs numbers and so forth, the dollar has a bid back under it. It's also still just a bit of a warning shot. But of course, inevitably, somebody's going to point out to me, but the VIX, man, it's dead. Yeah, it's dead until it's not. And the key is over here, you're thinking, volatility is kind of abated. We've got a bid back under us over here. We're still only a stone's throw off the all-time high, okay? But the next few days and the remainder of this week, it's critical to see if some of that volatility is going to come back. If you have, 2 consecutive weeks of smashing expected moves, that would be one thing. But I got to tell you, so we smashed expected move. And again, I want to reiterate this so everybody sees. We smashed expected move 2 weeks ago. Last week, we finished the week mildly higher. Volatility contracts. This week, though, it's important. You smash through the upper edge of the expected move. At that point, it is going to change the way we feel about markets. And that's why I'm telling you, Thursday and Friday, and the remainder of this week, there are mild catalysts. There's not much going on in the calendar. ECB minutes, nobody cares. Bank of England, nobody cares. Maybe it's a little bit of jobless claims, a 30-year bond auction. It's not that critical of a week, okay? But how we close in the SPX absolutely is. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.